Thank you all for joining us once again for the 4th edition of the End Conversation. We are very glad to have you. And as you can see on the screen, today it's quite busy. I have a few of my colleagues who've joined in, and we have a very brief message for you. So I will request the team to just go ahead and share the message.
Lydia.
Thank you all for your loyalty
in this season.
Manage your
expenditure.
Save more.
Flatten your debt curve.
Flatten your debt curve.
Here to serve for a better tomorrow.
For a better tomorrow. All right. Thanks, everyone.
Flatten the debt tomorrow.
The internet connection was different for everyone. So I'll just read out what they've just said. We thank you all for your loyalty in this season. We ask you to manage your expenditure, save more, flatten the debt curve, and we are here to serve you for a better tomorrow. So thanks a lot, guys. I'll request you to kindly mute your screens and your audio, and then we'll get started on the webinar. Today's webinar is the 4th edition of the End of Conversation, and it's on the impact of COVID-19 on international markets and investments. I'll request Mr. Wafubwa to please get us started and just say a word before we start.
Thank you so much, Bansi, and we are quite honored this morning to host all our attendees, and we are looking forward to have about 200 trustees on this webinar today. The resilience has been awesome. The commitment and loyalty has been awesome. That every week we have had chance within our 1 hour to just share information that would help our clients, our fellow stakeholders in the industry in terms of how they can respond appropriately in the unique challenges arising out of the COVID-19 situation. And this morning we are quite privileged to have Peter Jarvis, who works with African Alliance all the way from South Africa, and also Mr. Kaniu, who is also the CEO of Britam Asset Managers, coming on board to share with us quite some deep insights in relation to investment space as far as COVID-19 is concerned. Hopefully you are going to respond to the opportunities arising out of COVID-19. We as NWEL remain committed to continue to work together with you, and in any way that we could be of help, we could be of support, we are at hand to support you and serve you. Otherwise, I wish you all the best, and I am for sure quite confident that you're going to learn a lot more. And should you have any feedback, please drop us an email or reach out to us. Towards the end, we are going to share with you our contacts that could be of help to you. Over to you, Bans.
Thank you, Simon. And just in terms of using the different functionalities during the webinar, we have the Q&A function. If you have any question during the presentations, please feel free to drop a question there, and we'll try to answer as many as possible. We have the chat functions. You're able to send the panelists a chat. So if you need to talk to us, do that. And also you should see on your screen the raise hand function. If you need to speak after the presentations, just raise your hand and we'll allow your audio to be able to speak. So without further ado, I'd like to welcome the first presenter. I can already see him at the beach. It's Mr. Kenneth Kaniu. He's the CEO of Britam. Ken, feel welcome. Please share your screen and then you can get started on your presentation.
He's on a real beach. Ken, you need to tell us whether you're on a real beach or in some beach, in some place. Yeah, over to you, Ken.
Very good. Thank you very much and good morning. Just to confirm, can you hear me?
Yes, we can hear you.
Very good, thank you. Obviously, as has been introduced, my name is Kenneth Kaniu. I'm the CEO of Britam Asset Managers. And I think firstly, thank you to Simon and the team from NWealth for this very kind opportunity to obviously come on this webinar and spend some time with you and also with the 110 trustees that I can see are on this call. So good morning to all of them. And I think to Peter and Bansi and the rest of the team, good morning as well. I think Simon, obviously, as you mentioned, with COVID-19, everybody isolated, everybody chose to retreat. Some people obviously isolating in their homes.
Yeah.
Clearly you can see from my background, I also went somewhere. So I can confirm that I'm isolating.
Yes.
And that I'm safe. Well,
yeah.
In terms of the location, you know, everybody goes where they where they know best. So thanks for that. So I think what I've been asked to do this morning is to speak for, I think it's 15 or 20 minutes, to then chat around the impact of COVID-19, but more importantly, to talk about what kind of this holds for alternative investments and whether a case can actually be made, and as far as alternative investments are going to sort of come through at this. So what I will do at this particular point is to share my screen. I do have a presentation ready that I want to walk everybody through, and so I'm just going to do that now. And I believe that technology will work. So I believe you can see my screen now. I think on the NWealth side.
Yes.
Oh, wonderful. So let me then attempt to do that. I think in terms of a table of contents, this is what I want to run through, really speak about, let me call it a bit about Britam, real estate, private equity, and infrastructure. Because to us at Britam, when we talk about alternative investments, particularly in this part of the world, those are the three asset classes that we tend to speak through, which are real estate, private equity, and infrastructure. And I think the reason we are talking about this is because we have seen the horrific impact of COVID-19 on the economy, not just in Kenya and East Africa, but truly right across the world. I think we've seen here in this part of the world that if you look at various sectors of the economy, particularly the real economy, you know, whether it is transport, agriculture, to some extent construction, you know, all of these FMCG, logistics, supply chains, a lot of this have come under a lot of pressure. And we've seen a lot of companies, particularly those that are heavily exposed to those kinds of sectors, come under a lot of pressure. Specifically, what that has meant for many pension funds is that the investments that we've made over time, particularly in the traditional asset classes, have really come under a lot of pressure. As an example, we saw that in Q1 of this year, 2020, the stock market lost 25% of its value, which is a huge, huge loss in value. That has since recovered in the month of April. I did see that the NASI was up by close to 5%, which is good. So there's some level of a recovery that is coming. But truly, 25 minus 5 is 20. So the stock market is still down by 20%. I think we've seen that from the point of view of Kenya, we have obviously seen the currency come under a lot of pressure. From, let me call it maybe 101, 102 shillings at the start of the year, we are now closer to 106, 107. So truly there's some strong depreciation that we've seen there. And it's only a matter of time, to be honest, before we then start to see interest rates then start to pick up, because obviously that's the automatic stabilizer. And we're obviously beginning to see the government come under pressure. And as far as tax revenue and so on and so forth is concerned, which will begin to put more pressure on interest rates and on bond portfolios and bond valuations and bond yields. So truly, you're talking of a double hammering in equities and bonds, which is perhaps why, the current topic is about stability, about diversification, and perhaps that's why we have a renewed focus on alternative investments, is what I want to speak through today. Very quickly, just to talk about Britam, because it'll not be fair to talk about Britam. Britam, as you well know, is a company that's about 55 years old in Kenya. Life insurance, general insurance across 7 countries. But I head up the asset management company, and the asset management company was set up in the year 2004. So we are perhaps, we call it 15 or 16 years old, licensed by the RBA and CMA. And you can then see how we are split up in terms of our line of business. So we truly have 4 lines of business. From a retail perspective, we manage, let me call it unit trust funds and wealth management funds, possibly managing more than 35 billion shillings worth of assets there. On the institutional side, we manage a lot of money for pension funds, insurance companies, endowment funds, and so on and so forth. Perhaps another 170 billion there. And in terms of real estate assets, we do invest quite strongly in real estate, both for our pension funds. Our pension funds are perhaps combined more than 35 or 40 billion worth of real estate assets. So this is either land or it is actual income producing assets. And of course, let me call it on the Britam side, in terms of our own Britam balance sheet, we do have a large portfolio of more than 20 billion shillings worth of real estate assets. In terms of let me call it assets under management, we ended the year last year at about 220 billion shillings. So it's a strong growth that has come through, with a lot of it having come through from pension funds. And truly, I think our focus on alternative investments has been one of the things that our customers have been fairly happy with us about. So let me quickly start with real estate, and I'm just mindful of time as well. And you can see that from a real estate perspective, we are truly talking of land, buildings, and so on and so forth. And it truly is the largest, let me call it, asset class we have in the world. We obviously love real estate, and many pension funds have invested into real estate over time because of these particular reasons that are outlined there. So if you look at the diversification that then comes through, you'll find that real estate is not correlated to what goes on in traditional asset classes. So whereas equities are down by 20% this year, real estate, in fact, has held its value, to be honest, which is quite good. So that diversification element is great. It tends to act as an inflation hedge. And I think I mentioned earlier, we're expecting inflation and subsequently interest rates to begin to pick up. So it does tend to appreciate at a return that tends to be higher than what I'd call average inflation here. In terms of capital gains, tax benefits, stable cash flows, I think those are some of the reasons that investors and pension funds have invested in real estate. But if you look at some of the risks or some of the disadvantages, these are certainly there. We have a lot of what we call information asymmetry with real estate, because if you look at stock markets, bond markets, you have indices, you have price indices, you have benchmarks. With real estate, you don't have benchmarks, you don't have price indices. It's very difficult for you to know what is the real value of your asset. It's very difficult to know what your neighbor then valued his asset at, or what he then sold his asset at. Getting access to information is not very easy. We've seen over the last couple of years, a lot of properties being, in our view, overvalued, meaning that you may be valuing your property every year, and it may be appreciating in value by 10% every year based on the valuation that you receive. But once you go and test that valuation in the market, and once you want to then sell it, that perhaps is not the value that you get. And oftentimes you find that when you want to sell a property, the value that you receive is very different from the reserve price that you set. And unfortunately, let's call it pension, then find that the asset is generating liquidity that is less than what had been anticipated. You then obviously have a gap. We also have from the point of view of what we have with equities and bonds. I think those are some of the things to keep in mind. I think having said that, if you look at the latest statistical numbers, and you can see there that real estate accounts for close to 20% of or a typical pension fund investment. So it's a significant portion of a pension fund portfolio. And what has happened over time is that pension fund assets have tripled over the last 5 years. We've gone from, let me call it, maybe 400 billion, we call it in 2011 peak today. So we've then seen that as pension assets or pension liabilities have grown and tripled, we've not seen that growth come through in change. We still have the same 55 companies that were there, let me call it 10 or 15 years ago. In fact, instead of more companies being listed, we have companies which are potentially going to be delisted. So the stock market is not growing in summary. We've not seen on the corporate bond side new corporate bonds come through over the last 3 to 4 years, particularly off the back of the defaults that we've seen at government bonds. And as much as the auction sizes have increased, we still have only the one bond coming through every month. So the challenge for a lot of pension funds is, what do we do with this money? Because our liabilities have tripled over 5 years, but the capital markets have not grown as rapidly. And I think that is why you've seen so much money deployed into real estate, with the average fund, according to the RBA, actually having 20% of its assets into real estate. How does one invest into real estate? You can do it either directly or indirectly. If you do it indirectly, you're talking here of property funds or REITs. And you do know that we have one REIT listed on the stock exchange, which is the Bahari Income REIT. But very few funds have gone that route. In fact, we have just about 710 million shillings that has been invested into REITs or into property funds, which is the indirect route. Most pension funds tend to want to go for what you call the direct route. The direct route is where you own real estate directly. You either own the land, you own a building, you are actively engaged in the development of a real estate asset, and truly you fully own it. And you've tended to find that, almost all the money, it's now more than 230 billion shillings worth of pension fund assets, actually committed to real estate through the direct route. There are various ways to buy property, and these are some of the strategies that are there. If you look at what we call the core asset strategy, here you are buying into income producing properties. These are properties that are generating strong income in either the residential, commercial office, or retail side. And if one is buying into an income producing asset, this tends to be the best asset class, so the best real estate strategy to then pursue. One can buy into properties, of course, which are not obviously fully let. You may buy into properties which need some improvement, but as you improve a real estate asset, then obviously one is able to unlock a greater potential for return. And that's what we call our core plus or our value add strategy. We also have a lot of funds who, from a strategy perspective, want to go for direct developments, either residential, commercial office, retail, or hospitality assets, because they are chasing the development return and the development gain and the development IRR that would come from a property. So it really depends on what side of or what level of the risk spectrum that you want to play on. If you are more of a low risk kind of pension fund, fairly conservative, you truly want to go for an income type approach, then perhaps you want to go for income producing properties. But if you are a younger scheme, defined contribution, higher risk appetite, then possibly development assets is what you want to go for to be able to unlock those longer term development returns. And you can then see that in terms of what I would call the conservative funds, because many of the funds that we've seen over time have tended to be fairly conservative, they've tended to want to go for income producing real estate assets. And truly you're seeing here that what they want is a de-risked investment, so they don't want development risk. They want an asset whose income is coming through from leases that have been signed up by tenants and possibly long-term tenants. And so truly they're looking at income. So really you're looking at income that behaves almost like a bond. Obviously leases in Kenya tend to be for a period of 5 years and 6 months, and they tend to be renewed fairly frequently. So it becomes a fairly longer term asset that can be used to offset and match pension fund liabilities. And we've also seen in Kenya, the emergence of dollar leases and dollar rentals, which truly can be helped to offset against any currency depreciation that you can see. And I think for us in Britam, this is some of the criteria that we've used to be able to advise our customers with respect to investing into real estate and income producing real estate assets, with respect to leases, occupancy rates, escalations, cap rates, locations, process, where we go all the way from feasibility, concept planning, design, development, delivery, and truly what we call the asset management. And for many schemes, particularly on the residential, commercial office, and commercial retail side, this tends to be the process that they tend to want to run through. So it tends to be a 2 to 3 year process. We tend to want to advise schemes to get into developments where they can mitigate fully against market risk, because you know the way the real estate works, particularly 4, 5, 6, or 7 years ago, I think the message was if you build the real estate, the tenants will come. But these days it's the other way around. You'd rather have the tenants first before you then go and buy or set up the real estate. And this is to avoid a scenario where you have an income, where you have a development property, you have a commercial office block, or you have a mall which then goes empty, which is what we've seen with many real estate has remained empty for 2 to 3 years. And that obviously is happening because of the kind of supply that we are seeing in the market. There's huge supply of commercial office space in Kenya, as an example. In the last 3 years, you've seen more than 1 million square meters of office space being approved by the local authorities. If you look at retail and you look at shopping malls, we truly have, in our view, too many shopping malls in Kenya. So we truly have what you call a tenant's market or a buyer's market. So that then means that one has to take the speculation and the market risk out of real estate, and one has to be able to develop what you call purpose-built real estate. You need to be able to have some level of, let me call it, pre-reads, pre-assessment. You need to be able to have some tenants who can buy into your development ahead of time to be able to reduce the risk of running empty with this property over time. So these are some of the potential risks that we've seen with real estate around liquidity, lease renewal, which really is occupancy, market risk, which is obviously the supply issue that I was talking about earlier, and development risks as well, because we've seen a lot of projects being wrongly implemented. You have the wrong professional teams on board. You have the wrong motivations with respect to professional services being rendered. So it's very important to make sure that you have a professional team, professional staff, who can then ensure that every decision that's being taken with respect to a development is actually value added from the point of view of the pension scheme, especially from the point of view of overall returns. One, as I mentioned earlier, is worth of real estate assets. And Britam ourselves, on our own balance sheet, we have more than 20 billion shillings worth of real estate assets. So it's an asset class we do believe in, but it's very important for one to be able to be aware of the risks, that one can be able to make the right decision. From a private equity perspective, I think that's the other thing I want to talk about. Once again, you can see that if you look at what the RBA is telling us in terms of global asset allocation, private equity investment is at a paltry 0.07. So truly almost nothing has been invested into private equity over time. But I do note that that 0.07 is much better than the zero that was there a couple of years ago. So it is growing, but growing at a fairly slow pace. For a lot of pension funds, some of them have chosen to invest into private equity directly, which means that they have invested directly into companies where they have a direct stake and perhaps even have a seat on the boards of those particular companies. I think the reason why some of the pension funds have liked that is because you have complete autonomy from the point of view of the investment. And by that, I mean you have full control. If you invest through a private equity fund, the fund is the one to make the decision around when do you invest, what is the right valuation to carry, when do you then exit. But if you invest directly, you're the one in control of the investment. And to be honest, as long as you like it, you're the one who has obviously the control over entry, exit, and those kinds of things. We've also seen that if you look at value creation, we've also found that for many pension funds, they have felt that from a value creation perspective, they would be able to have some of the skills that are required, particularly if this is an investment that has come through from the sponsor. They have sometimes felt that those linkages are things that they would want to be able to work on over time. Of course, there are very strong risks and very strong cons there. I think the first one there is what you call concentration risk. So we've certainly felt that in terms of concentration risk, one may be exposed to a particular company. From the point of view of liquidity, how does one generate an exit out of a single company investment? And secondly, it's a fairly expensive way of investing into private equity, actually investing directly into a single. I think to note that private equity investors have then done is to invest through funds. And that is truly our preferred methodology with respect to investing into private equity. So we typically want to invest into private equity funds which have a strong track record. We want to invest into funds which have what we call proprietary deal access, meaning that they are able to originate their own deals and not rely on others for deals. And truly, we like investing into funds because of the diversification element that funds are able to be companies, as opposed to investing directly into a single company and having that. We've been very positive for pension schemes is the fact that if you invest into a fund, you obviously lose control. So you cannot pick and choose what kind of investments you then want to get into. And then as well, you do have that in terms of the performance results. You have a lot of variability with respect to the performance results. You typically find that not every company in the portfolio will perform. But I think what has been found over time is that the performance of the companies that do perform tends to outweigh the companies of those that don't. And I think because of that, that has been the preferred approach for many pension funds and asset managers. They have tended to want to invest through private equity funds. And I know that many of you who are listening may have already invested into private equity funds that have been there over time. Whether it's ECP, whether it is Ascent, and so on and so forth. I do know that several funds have made investments here. And what we do usually propose for our class customers is to invest into a different fund every single year. What you then want to do is have a portfolio of uncorrelated private equity funds, so that as one is drawing down on money, another one can be returning cash. And truly, you can be able to benefit truly from diversification, because if you're in 5 different funds, which have 10 companies each, then truly you'll have exposure to 50 different companies that are there. We like private equity because of the stability that we see from the point of view of returns. They don't fluctuate the way we've seen returns fluctuate recently in the listed market. And again, you also get access to companies that one would not typically get access to if one was only exposed to the stock market. So if you look at the stock market, it's only 55 companies. But if you do look at the unlisted side, we have more than 10,000 well-performing companies in Kenya. And to be honest, there's no reason why a pension fund should not be able to get access to those kinds of companies. The other thing I want to run through lastly is infrastructure. Infrastructure is also a fairly good asset class for one to invest into. We have what we call economic and social infrastructure. Economic infrastructure is investments into transport, energy, telecommunications, schools, hospitals, and so on and so forth. And it is investment that is made for purposes of generating an investment return. And we typically have seen that in these kinds of sectors, one can be able to generate a return from these kinds of investments. That is very different from social infrastructure, because social infrastructure is investment that is made to meet social needs. And you typically find that the returns that are generated from social infrastructure oftentimes are not sufficient to cover the costs of such investments. And that is why we found that such investments are typically financed by the public sector. That is actually government, and really it is the role of government to be able to provide that social availability to obviously fund the economy. From the point of view of infrastructure, we typically advise our customers to access investments into infrastructure just like any other investment, meaning that you need to look at both risk and return and the bankability of these particular projects. These investments can be classified into either greenfield or brownfield projects. And with a greenfield project, you're talking about a brand new project. You're talking about a project where you're the one to undertake the development itself. So you're providing the development capital. You're certainly bearing what you call development risk and implementation risk, because one obviously is now subject to obviously the engagement with contractors, whether the development is done on time, on budget, and with the right quality, and so on and so forth. So it can be fairly risky, but it tends to also generate a higher return. That is different from what you call a brownfield investment. And a brownfield investment is an investment into an already existing project. So here you would be, as an example, buying into a road project. You're buying into a road which already has a toll. One would obviously be booking their income based on the tolls that are coming through. Or one would be buying into an existing power plant, which has already been commissioned, it's been tested, already generating energy. It's already obviously receiving capacity payments. So what truly one would be doing here is buying into the income stream. So the risk here is much lower because the project is already tested and is generating cash, but the return also tends to be lower than that you would get from a greenfield project. Again, with infrastructure, these investments can be made directly into the asset or indirectly through an infrastructure fund. And I think the pros and cons are quite similar to those that we described on the private equity side. If you look at the global rationale and some of the risks for infrastructure, I think they are fairly well known. If you look at infrastructure assets, these tend to be long dated with a life of 10 to 30 years. So these typically match the long-term nature of pension assets fairly well, because again, pension fund assets tend to have, let me call it, a fairly long-term nature. If you look at infrastructure, again, it has a very low correlation with other asset classes. So in terms of diversification, they're very good for diversification and stability of returns. And again, if you look at many infrastructure investments, they tend to be in the area of utilities, so sort of power, water, roads, and so on and so forth. And these kinds of utilities tend to be immune to economic cycles. And if you look at what's happening now, even in light of COVID-19, I think any investment that one has made into power, into water, into telecommunications, transport, these are probably investments that are still doing fairly well as we speak. From the point of view of risk, this is an asset class that tends to be quite illiquid with limited exit opportunities. So if a pension fund is looking to pay expenses or meet pension fund benefits, this perhaps is not the asset class to generate the liquidity. So a pension fund should actually do a very good liquidity assessment prior to investment to be able to ensure that the funds that are committed to infrastructure can actually be there for the long term. I think another risk to then note is to political risk. They can be subject to changes in government regulations of perhaps a tax nature or income nature. And this can obviously have a detrimental impact on investors. So it is very incumbent on the investor or the pension fund or the fund manager to invest into a project which is well de-risked, where risk mitigations are actually very well set up to avoid the negative impact of any changes that can come through as a result of government legislation. And I think just to round up, I think Britam does have investment with, or rather have experience with investment into the power sector. And you'll recall that in 2019, in January 2019, we made a public announcement of our first investment into infrastructure. We invested 1.4 billion shillings into Everstrong Power, which is an infrastructure and energy fund. And these funds were used to buy a stake into the Athi River power plant, which is an 80 megawatt heavy fuel oil or diesel power plant. This power plant is owned and operated by Gulf Energy, which is one of the top oil and gas players in East Africa. This plant was set up and commissioned in 2014. It has a 20-year PPA that has been signed up with the regulator, which is Kenya Power. And truly, it is an investment that has generated a lot of value for our customers and for Britam. It is typically paying us what I'd call dollar returns, which are north of 10%. And I think through this investment, Britam and its customers are playing a very good role and key role in terms of the provision of funding into the power sector. And our customers are certainly benefiting from the diversification and the stability to returns that this investment has provided. It took us about a year to conduct due diligence into this particular fund and into the actual power plant itself. It was a fairly expensive exercise, but I do note that in terms of, I think, the track record and the skill that it has brought into the company and for our customers, I think that is something that has come through as fairly beneficial. So I think, ladies and gentlemen, that brings me to the end of my presentation. I sincerely hope that I have been clear and articulate in terms of the message, in terms of the speaking through, because I do know that virtual meetings are virtual meetings. They do obviously have their fair share of issues. So thank you very much for that. And I think, Bansi, back to you. Thank you.
Thank you so much, Ken. It was very clear and on my end and quite insightful. So I'll request all the participants, if you have a question, please just use the raise hand function to raise your hand and I'll unmute your speaker. In the meantime, I think we have two questions here. One from Bernard. He says that Britam has been big on property development, but is it really the best way to go given the oversupply of office space and even rentals across major towns, especially in Nairobi? Isn't it risky to invest pension funds heavily in this asset class? And then the second question that you might answer is by Peggy, who asks, what category does investing in shares fall?
Okay, Bansi, would you like me to answer these now?
Yes, please, if you can answer the two, and then we'll take any more questions after that.
Absolutely. No, thank you, Bernard, for that question. There's certainly, and I agree with you, there's certainly an oversupply of office space in Nairobi as we speak, and rentals across the major towns and even in Nairobi actually headed downwards. So what that means is that at present, it is fairly what I would call risky to invest into, let me call it, a brand new office block right now as we speak. However, what we have found is that for those investors who had invested into real estate, let's call it 2 or 3 years ago, and for those investors who have good occupancies and good leases and so on and so forth, they are currently, as we speak, smiling all the way to the bank because leases continue to be enforced, rentals continue to be paid, and so truly we've not seen what I would call any dislocation as a result of the oversupply that has come in. So truly, real estate now is beginning to perform just like any other asset class. It is now driven by demand and supply factors. And the reason that we have an oversupply in commercial office and even in commercial retail as we speak is because 2 or 3 years ago, the demand was booming. There was huge demand for office space from the point of view of tenants, rentals were rising. So now we have an oversupply. So it is also just a matter of time before that oversupply is then taken up. And we then have another boom that comes through from the point of view of real estate construction and new investment into the sector. So it is cyclical. I think timing does play a big role with respect to real estate investment. But I think for those who have made the investments over time, for those who have reasonable occupancies, I think they are fairly happy. If you look at the second question from Peggy, into what category does investing into shares fall? Investing into shares falls into what we call the equities asset class. Those are what we call traditional investments. So they are not alternative investments. Those are traditional investments. And so any shares that are invested in through the stock exchange and so on and so forth do fall into the traditional asset class. If you look at Peter Ochieng, there's a question around what was the average return for private equity in 2019. I think what we've seen is that for many private equity funds, which then subsequently started to return money to the investors in 2019. The dollar IRRs tended to be between, let me call it 12 and 15% dollars. Those are fairly strong returns. And if you convert that into Kenya shillings, especially based on the depreciation that we've seen currently, you're talking of returns of at least 15 to 20% in Kenya shillings. So those have done fairly well, but those are only for the funds that are returning money to investors this year. I think there are other questions there that I can see have come through, and
yes.
they do continue to come through. So Bansi, I think I'll just take your guidance as to whether we continue. Do we have a chance to the other presenter to proceed as I then, and perhaps we can answer these towards the end.
Okay, I want to allow a few people to speak. Emily Odindo, I see you raised your hand. Please, if you may unmute your speaker and just go ahead. We also have Peter Njau. Please unmute your speaker and ask your question.
Hello.
Yes, Peter, we can hear you.
Good morning, all of you.
Good morning.
Thank you very much, Bwana Kennedy, for that presentation. My question is the fact that the P returns do not fluctuate. And companies, we are seeing some companies having problems at this particular time. Do you think they cannot be, there is no risk in that case?
Thank you, Peter. Susan, please ask your question.
Hi, my name is Susan. I'm from Additive. I wanted to ask, what does Britam have in, what's the plan of Britam in terms of COVID on reaching out to their customers virtually and seamlessly?
All right, thanks, Susan. Ken, if you may answer those two questions.
That's right. I think, thank you, Jao, for that particular question. I think Jao is asking that if we are saying PE funds don't fluctuate, then what does that mean for risk? What does that mean for returns? And what does it mean for the current environment where we are seeing companies then closing up and so on and so forth? So obviously, if you do look at private equity funds and the companies that they have invested into, there are many that have been affected by the pandemic, and it is true. So there are some that have reduced operations. We then have staff working from home. Many companies cannot export their goods and services, not just across counties, but even across borders and so on and so forth. But we also have other companies that are actually doing fairly well as a result of this pandemic. And you may know some of them along the lines of logistics, along the line, and if you look at some of the delivery firms, you know, the Ubers, the Glovos, those are doing extremely well. If you look at the investments that have been made into IT companies, and private equity, I know, has funded a lot of IT companies. The investments made into telecommunications companies, FMCG, you know, these are all sectors that at present are actually booming, even with the pandemic. So I would say that it is a mixed bag, and that is the benefit of the diversification that you have there. Because as some companies come under pressure, there are others that tend to do fairly well. So I would say that we are yet to see any what I'd call negative impact associated with the valuations that we've seen from private equity funds. We will continue to monitor these valuations as they come through, but because of that diversification element, I think that is something that has held its value fairly well. The next question is from Susan. What are we planning to do as Britam to engage with customers because of this COVID-19 pandemic? So I think what we've been doing, Susan, is that we have taken to regular communication with our customers. So I do know that there have been many phone calls, there have been many emails, there have been many newsletters. We have sent through many, many reports to our customers. So I do feel that that has happened quite well. But I also do know that there has been some requests that have come through for us to host some meetings, which is what we're actually planning to do. And I do know that before the end of the next, let me call it 2 weeks, you should see more virtual meetings come through from Britam, specifically with respect to engagement with customers. We're quite happy to know that for many pension funds, they have continued to work. I'm sure many of you are in receipt of the public of the government guidelines with respect to virtual meetings. So I am glad to know that many virtual board of trustees meetings have now begun to happen, which I think is good. And truly, we need to be able to work through this pandemic, because in as much as COVID-19 is here, that doesn't mean that we stop doing the work with respect to making sure that we preserve member benefits and even grow them to a large extent. So Susan, I think sit tight. We are coming for you.
Okay, thank you, Ken. I'll allow 2 more questions. The first one is from Nelson Midamo. He asks, is it true to say that property valuation in Kenya and specifically Nairobi is very high, which in turn limits the rate of return for investors? And as you answer that, I see Eric Mudomi has raised his hand. So Eric, I'll allow you to talk. If you may just unmute your speaker and ask your question.
Thank you very much, Mr. Kaniu. Thank you for that presentation. My question is very specifically directed towards Britam's wealth management fund. And my question is, we've recently seen a reduction in the yearly rates. And we are wondering, some of us have their accounts coming to falling due, that is, they're up for renewals. We were wondering whether to wait for the rates to come back up again for us to renew, or what's the direction you would advise us on that because we don't want to renew the lowered rates. Is there a timeline for when the rates will go back up again? Thank you very much.
Okay, Mr. Kaniu, if you may answer those two questions, and then we'll wrap it up.
I think that's fine. I think let me start with the written ones first. I can see that there's a question here around property valuations in Kenya and Nairobi being high. So does that limit the return to pension schemes? Nelson, what we've seen is that property valuations in Kenya tend to be, in our view, quite aggressive. And secondly, they are not tailored to suit the requirements of pension funds, which I think for us is a very specific point. We've seen that from a pension fund trustee, especially if you have questions around the assumptions that have been used to generate that property valuation. What assumptions have been used? Are they looking at comparable properties? Are they valuing the properties using some kind of valuation model? Is that in touch with the growth of your liabilities in the scheme? I think all those questions need to be considered, because if they are not considered, what we have found is that some of the valuations that are returned tend to be very high. We tend to see that sometimes, assuming you value a property annually, you may find that the valuation that comes through kind of values the property upwards by 8 to 10% every year. That would typically mean that in 3 or 4 years, your property has now been revalued upwards by 30 or even 40%. And I think what we found, and we've seen that with many schemes, when they then try and go off and sell properties, they have found that the reserve price that they put in the market, which is pegged to the valuation, is sometimes very different from the offers that come through from potential buyers. And truly, the value of an asset is not what your value says. The value of the asset is what someone is willing to pay for it. That is the way it works, to be honest. If someone is willing to pay you 10 billion shillings for your asset, yet your valuation says 1.5 billion, then 1 billion is the real value of the asset. So a lot of schemes have run into trouble when, as far as that is concerned. And our guidance to these schemes has been, please allow us to have some input even before the valuation comes out. Allow us to have some input into the assumptions underneath that property valuation, because if you have the right assumptions, then you can actually come up with a valuation that is acceptable in as far as pension fund liabilities is concerned. The other question is from Anthony Komani. Does Britam have its own in-house real estate management team? Yes, we do. Britam and Britam Asset Managers actually runs a property company called Britam Properties. And in there, we have qualified investment analysts, architects, QSs, and so on and so forth, who are really responsible for the engagement and delivery, not just on Britam in-house projects, but also with respect to investments from the point of view of our pension funds. And I think in many of the reviews that we've had from our pension funds, both existing and potential, this has always come out as a very strong point as to why Britam has then been allocated so many of these real estate assets. I think for Eric, from the point of view of the wealth management fund, you are right. The rates were reduced off the back of the pandemic. I think, as I mentioned earlier, currency depreciated strongly, inflation and interest rates will pick up. So we did that to obviously protect the returns and capital and principal that we have for our investors. We will only be able to revisit this issue of raising up the rates once we then start to see the economic impact of COVID being mitigated. So I think, Eric, I don't have a specific date or a specific timeline, but we are certainly talking of at least the next couple of quarters before we begin to revisit this issue again.
Thank you so much, Mr. Kaniu, for your responses. I think we'll end it there for the first session because of time. On your screen, you should see a quick poll and a request for your feedback. So for the people who are in pension funds currently, do you know whether you've invested in any kind of alternative? So just type a yes or a no, and then we'll pick it up from there. So I'll give us a few minutes to answer that. In the meantime, please feel free to continue the conversation on social media. You may reach us on Facebook, Twitter, or LinkedIn. Our handle is NWealth Kenya, and on LinkedIn, NWealth Financial Services. So please feel free to also proceed with the conversation even after the webinar. So I'll give us another 20 seconds to just answer the question. And then I'll invite Mr. Jarvis to get his presentation ready and also share it on the screen so that you can go ahead.
Hopefully that should now be on the screen.
Yes, we can see it.
Excellent.
So welcome, Peter. Peter is a Chief Investment Officer at African Alliance, a company he's been with for over 8 years. So I'll allow you to just take it up from here.
Perfect. And thank you very much for the introduction. And thank you very much, ladies and gentlemen, for zooming into today's presentation. As you can see, the title of my presentation is Global Markets and COVID-19, or what is now being called by the markets the Great Virus Crisis. Sorry, just by way of introduction, you know I'm the Chief Investment Officer for African Alliance Asset Management. I'm based down here in Johannesburg in South Africa. And what I've put here is just a snapshot of our investment portal, and sort of after the presentation, feel free to subscribe. If you do subscribe, you'll be able to access our newsletters, and we have a function called African Alliance Alpha, which gives economic analysis and also our market watch on a regular basis. So as I said, this presentation will be distributed and there'll be the details from that. So just in terms of this morning, I'm going to do a fairly brief presentation in the 15 minutes, and we'll use this then as a base for Q&A, because obviously with global markets, it's a very broad investment universe and a lot going on. So it's difficult to sort of focus too much, but I've tried my best. In this morning, we're going to start by looking at the global economic backdrop, where we are now, some of the catalysts for a faster great virus crisis economic rebound, and then we'll look a little bit at the fiscal and monetary response from governments and central banks around the world. We'll then try and extrapolate some of this onto our asset class views, primarily global equities, and here you'll see I've put the good, the bad, and the ugly, and I think, as Ken was saying, there's always opportunities in these COVID crises, and we'll explore some of those, and then look at those that aren't faring quite so well. We'll then move on and have a look at the global fixed income space, and then finally a little bit on commodities, namely sort of the gold and oil prices. And then lastly, I'll spend a little bit of time on the benefits of global asset diversification, but that slide again will be more for what we talk about in the Q&A. So as I'm sure you're all quite aware, with all the lockdowns that have been going on and the lack of trade, etc., and it's been very well documented that the global economy has fallen off a cliff. And I think, one of the stark indicators is if you look at the US economy, it shrank in the first quarter at the fastest pace since the 2008 crisis. And that in itself ended a period which was the longest expansion period on record. And obviously, it's not just the US. If you look at the data that's coming out of Asia or Europe, the PMIs, industrial data, jobless numbers, consumer confidence, they've all fallen to record lows. And since the financial crisis. So I think, we know that's happening, but what's the market's response? And I think the clear thing is that policymakers and investors are turning to their attention as to when and how lockdowns get lifted. And I think it's all clear that, if we ease restrictions too soon, we could see a resurgence of the virus, and then the market panics against a second wave. And also, if we draw out the lockdowns too long, then we're likely to see another fall off in PMIs, etc. The other thing as well worth noting is that when we see restrictions getting lifted, it won't necessarily translate into a rebound in activity. And I think, if we look at the airline sector, that's a clear example. I think, as and when people are allowed to travel again or fly again, the protocols will have changed. You'll have medical checks as you get on. When you're on the plane, there'll be spacing, etc. And I think all these factors will have an impact in the dynamics of some of these corporates. I think, if you're looking for green shoots, encouragingly, business is picking up again in China. These were the first into the crisis, and they've sort of been reducing their lockdown since the end of February. And interestingly, if you look at the Chinese manufacturing purchasing index, it jumped to 52 in March, which was up from a low of 35 in February. So again, it's going to be interesting to see what happens in Australia and New Zealand, which again are sort of easing their lockdowns. And I think what the market needs to see is, the shape of the recovery. And as I said, one of the big fears is if we get a second wave of the crisis. I mean, thus far in China, we haven't seen it, but who's to say that won't happen? So what we're looking at as investors and market participants is to try and gauge what shape the recession and recovery will be. And by that, I mean, typically, if you have a shock in the economy, you can generally have a V-shaped recovery if things are going well, otherwise a U-shape if it's going to be prolonged, or even, as some fear at the moment, it could be L-shaped. The next slide here, as I've always said, you know, a picture speaks 1,000 words. And what I've put here is two examples of some of the economic stats. This is for the Eurozone. And you can see the chart on the left, it's for the Eurozone consumer confidence. And you can see the record fall, which was as severe, if not worse, than the great financial crisis of 2008. Both destruction from the last few years again is very evident. So I think, you know, it's worth bearing in mind that, you know, this has happened. And the other thing as well is that this is reflective of Q1. So of course the spillover of the crisis is happening in Q2, and we still don't know when the end is. But what are the catalysts for a faster global virus economic rebound? And I think there's three things that markets are looking at, and you know what we're looking for is confidence in one of these three. And the first one is obviously testing, because if we have a speedy or a fast and accurate testing regime, then of course it means that you can allocate resources and treat things better. And there's been some very positive developments in Europe and the US. We've now got blood sampling, which gives a very accurate result within sort of 10 to 15 minutes. And interestingly, they're even looking at sewage plants. So I hope you're not eating breakfast, but the Dutch and the UK are pioneering ways of sort of monitoring sewage, and by that they can tell whether there's COVID in the sewage and use that to sort of gauge where they need to direct their target plans for testing. The next thing that would be taken very positively by the markets, and we started to see this as we had sort of news flow from the University of Oxford and some of the US pharma companies such as Pfizer, is that as soon as we get a vaccine, then you know clearly it takes a lot of the risk off the table. And of course, the best thing of all would be as if we had a cure. I don't know whether many of you have seen in the press, but we've had Gilead, which is a US pharma company, have come out with a compound called remdesivir, which is a very promising treatment. It has sort of enabled or shown some efficacy, but again, it's not a Pandora's box. It's just a, it's just a start. So what have governments done and central banks? Because clearly, we'll come on to it in a minute, we can see that markets have rebounded quite strongly. So the real answer is that we've had central banks yet again to the rescue. And I think, the term QE forever, which is the quantitative easing forever, is basically the governments and the central banks are just throwing money at the situation, at the problem of the COVID-19. And I've just put a couple of interesting stats here. You can see that the Fed's balance sheet has ballooned by $2.5 trillion to a record $6.6 trillion since the end of February. And that's also been accompanied by a monetary response of interest rate cuts by the Fed. And if we look elsewhere, if you look at the total assets of the ECB, the Bank of Japan and the Fed, these have jumped by 3.2 trillion to the end of February, which was where it stood at 17.8 trillion. So this just sort of shows you the magnitude and sort of the aggressiveness of the response which the policymakers have put in place. And as we'll see in a minute, as I said, we'll see how this has impacted markets and why we've seen some form of recovery. The other interesting difference between this crisis and the banking crisis that we saw in 2008 is that banks globally, perhaps except for China, present a low to moderate financial stability risk. And what we mean by that is that since the last crisis, the bank's capital positions have strengthened significantly, and the regulators have put much more stringent capital requirements and supervision in place. A couple of interesting stats here as well, just while we're in this part, is the US personal savings rate has jumped from 8% to 13.1% in the first quarter. And clearly that's just a reflection where consumers can't spend their money. I mean, obviously in a normalized market, you'd go out to eat in a restaurant, you'd fly, you'd go on holiday, watch a movie at the cinema. So clearly that money is being saved. Now, as we come through this, that could be seen as a positive because the consumer can then lead the recovery. But also it just shows the magnitude of the problem. Just one other thing on the fiscal response. Again, President Trump has come to the rescue and he signed the CARES Act, which provides another 2.2 trillion in rescue programs for the economy. And what that is, it's almost a backdoor way of supporting infrastructure projects, almost like supporting the economy, but in ways which have been unprecedented in recent times. So moving more onto the asset class views now. So what's happened in the global equity space? As I said, and we've just seen, there was a huge amount of liquidity that's been supplied by the major central banks. And most of this was announced at the end of March. And as we'll see in a minute, the S&P 500 has bounded by about 25% since those lows. But this is obviously a sort of a top-down driver. You know, we've had the support from the central banks and the stimuluses. Now, what's happening bottom-up? Now, clearly, the bottom-up news is not great. And I've just put a stat on here. 73% of S&P 500 companies have reported and earnings misses at their highest since Q4 2008, which isn't a surprise given what's happening. But the problem with that is that's just a measure of Q1. And the bad news, or the really bad news to come, is if we thought Q1 results were bad, we ain't seeing nothing yet. And I think the Q2, from what we've seen being said by companies, is going to be much worse. So I think there's a dichotomy that if you look at markets from a bottom up in the equity space, focuses back on the tensions that we're seeing in the US and China. What we can see here includes the markets, and as you can see, at the bottom of the market in sort of March 23rd, we were around the 1300 level, and then post all this stimulus that was announced by the central banks and the governments, we've seen a sharp rebound of about 15–20%. Now, interestingly, there you can see that we saw this dip down, and then pretty much now we're where we were before the crisis. And in a minute, when we talk about some of the good buys and the good, the bad, and the ugly, you'll see the reason for that, because obviously these are some of the beneficiaries, or the strongest beneficiaries, of the current COVID crisis. So let's delve in. And as I said, we've got the global equities, the good, and these are the companies that are benefiting from this crisis. And I think it's clear that a lot of the technology companies, the e-commerce companies, are actually seeing a resurgence in their models. They've been the leader of the markets for the last 10 years, and yet again this crisis has shown them the relevance of these models. So for example, we've got Amazon, which has actually been recruiting 100,000 staff during the last few weeks, and obviously their e-commerce business is taking further market share from the old retailers. I put on here, I couldn't leave Zoom out, as is obviously enabling us to have this meeting today. And again, they've been one of these big beneficiaries of this move to hold virtual meetings and virtual. It's a game which is owned by Epic Games, which in turn is owned by Tencent. And interestingly, with all the kids at home not going to school, you can see the number of players in Fortnite has gone through the roof. And what they've been able to do is monetize this. And there's an interesting act. The other week they had Travis Scott, who is one of the world's biggest rap stars. They had a virtual character of him performing a concert actually within the game. And this had record viewership and record users in the game that Fortnite have ever seen. So again, it's just an example of how, it's not all doom and gloom out there. Companies are benefiting, and if you select your investments wisely, you can still make money. And on the next slide here, I've just put the share price chart, so you can see Zoom, which again we're all using. At the start of the crisis, the share price was around the 65, 67 area, and now we're looking at $143. So if you owned this a few months ago, you've made 100% on your money. And likewise with Amazon, I've put a longer term chart here because obviously this has been one of the disruption themes for the last 10 years, but even through this crisis, you would have made a good return, 15–20% in US dollars. So these are just examples of, you can't treat blanket, it's not a blanket approach to investing in equities. I've just put a couple more examples. So these are the bad. These are the guys that that haven't sort of, they've seen their businesses disrupted by this crisis, but haven't necessarily seen their businesses destroyed. And an example of that would be BMW, which I'm sure you all know, luxury car producer. Clearly around the world, auto sales are falling off a cliff. And the question is, will auto sales resume once we're through this crisis? And that is something that's still open for question. But the bigger problems for companies like BMW is over the last few years, shareholders have made them run very lean operations. And that means there's very little cash on the balance sheets. So unfortunately, when we have a crisis like this, it's very difficult for them to survive without going back to the market to raise more capital, either through sort of debt or equity financing. So that's BMW, which would be a consumer discretionary. And likewise with Starbucks, I'm sure you've all heard of that coffee chain. Now, again, the closing of stores has had a huge impact on their business. And interestingly, we had a conference call with the management team the other day, and they said that Q2 makes Q1 look great. So clearly, there's going to be a lot more bad news coming through. And a lot of these businesses are quite capital intensive. And if you dry up your revenue streams, then as an equity holder, it's your capital that gets eaten first. And just as an example, China is where the stores have begun to reopen, saw sales fall 34% in last month, but that was a recovery from the 90% fall which they saw in February. And then here we've just seen it graphically. So you can see here, the stocks benefited from the QE and the fiscal support, the top-down drivers, but clearly you would have still lost money if you held these in the last few months. But what the reason they haven't fallen further is that the market is still pricing in some form of recovery. And as when we started the presentation, I mentioned it's still difficult to ascribe what shape that recovery will take. But clearly, as an equity investor, there are investors out there who are hoping that it's going to be quicker rather than later. And then, of course, we have the ugly. This bunch of stocks are those that are suffering on many fronts. And I think we've all probably heard of Lufthansa, one of the airlines. And of course, the airlines are taking, amongst airlines and hotel stocks, are taking the biggest brunt, because clearly a lot of the fleet has been downed and idled. And at the same time, they have these operational costs of pilots and crew. And although some of these can be furloughed or laid off, it still means that there's no revenue coming into these businesses. And likewise, Chesapeake Energy, they're a oil and gas company in the US, and their main sort of exploration is the shale gas fields. Now, as we'll come to when we have a quick look at the oil chart in a minute, you can see that not just because of COVID, but other reasons, that the oil price has been decimated. And I think if we move on to the share slides, you'll see why we call them the ugly. You can see Chesapeake was $600 a year ago, and now it's $16. That's the bottom slide. And as I said, this is because of the collapse in oil price, and these companies, oil and gas producers, need oil to fund their businesses, or a high oil price rather, to fund their businesses. And as you can see on the top slide, the top chart rather, that's Deutsche Lufthansa. And again, that share price has fallen by 2/3. And if I put up there US Airways or Southwest Airways, etc., you would see a similar picture. And I think, incidentally, in the press yesterday, we saw even the esteemed investor Warren Buffett has offloaded his US Airways stocks. So moving on to fixed income, I'll try and speed up a little bit, but here, obviously the market has been supported by the central bank bond buying. And I think, at the moment there's an expectation that the bond buying is a panacea for oils, but we don't think it is. The reality is at some point there's going to be a reckoning. If you look at the huge amount of stimulus, huge amount of money that's being thrown by governments around the world, that money has to come from somewhere. And we think at some point, although markets you've sort of got this negative yield backdrop in certain developed markets at the moment, we think there is a risk on an upward pressure in yields as the markets digest exactly how bad the debt situation is. And I think if you look at what the rating agencies are doing, they've downgraded the UK and a couple of other governments as well as South Africa. But it's a sign that, the market is holding bonds in part for safe havens, but the reality is as the COVID crisis progresses, these might not be the safe havens that the market expects. Likewise, we've seen the Fed starting to buy some corporate paper, but again, for us, I think the sort of rating agencies' responses to this are going to be far more determinative of where that price goes. So I think for us at the moment, fixed income, apart from very few niche areas, is a strong sell for us at the moment. And I've just put some more incidental things here. You know, if we look at what businesses are doing at the moment, they're drawing down their lines of credit and preparing themselves for an impending cash crunch. And I think the other thing that we have to note as investors in the corporate fixed income space is to keep a close eye on covenant amendments, because clearly with the businesses in quite a lot of stress, we're seeing a lot of that in the transport, leisure and energy sectors. And the prior graphs I showed you for the Chesapeake outlines the stress that those sectors are taking. Just a couple of charts here. The left-hand one is the FTSE World Government Bond Index. And as you can see, typically in signs of stress, your global bonds would perform very well. And if you looked back at the global financial crisis, when interest rates in the US fell from 5% down to 0%, the bonds did spectacularly well, because obviously there's the inverse relationship between price and yields. However, this time, where we're already going into this crisis with such low interest rates, the room for capital appreciation as the yield drops, as interest rates drop, is very low. And also, as I mentioned, you know, the market is fearing earnings ratings downgrades, and also the fallout from all this government spending. And then on the right hand side, you can see the move in the, and clearly, you know, before this crisis, it was coming down because it was worried, you know, the market slight compression from rates. Moving on to commodities. Demand problem where, you know, airlines have stopped consuming aviation fuel, people have stopped driving their cars, so there's a glut of oil. And I think you probably might have seen flagged in the press that we actually saw a negative futures price in the oil price, and the reason for that was clearly there's not enough supply capacity or places to store oil, and so traders were having to offload there. So unlike shares, as we know, commodities can actually trade at a negative price. I guess one positive takeaway from this is that consumers that are still able to consume oil, they're getting a nice price for their petrol. And then lastly, on the commodities, gold. And, you know, as we'd expect and as modern portfolio theory would tell us, gold is acting as a safe haven asset. And I think not only are we seeing sort of the safe haven characteristics come into play, but unlike oil where there's a glut of supply, the supply backdrop for gold is very tight at the moment. And the reason behind that is when we had the last sell-off in the gold market, capex was pulled back aggressively, and therefore miners were sort of didn't invest in new capacity or new mines, which means we've now got a supply shortage in the space. So again, as I said, I think, you know, as long as this crisis rumbles on, we can expect to continue to see the gold price slowly edge upwards. Just lastly, before we move to Q&A, I've just put down, obviously bearing in mind and cognizant to the audience of trustees, you know, why would you want to move into global assets? And I think clearly, as I've tried to demonstrate, you know, there is a broader opportunity set of listed investments in the global universe. And I think, as I've shown, you know, even if the equity markets are in the, you know, in the dour place, there are always opportunities there to make money. And I think the thing to do as a trustee and bear in mind is to set your allocation to active managers who can perhaps navigate some of these themes or opportunities rather. Or you can these days buy ETFs, which are exchange to invest in the equity markets. The other reason, of course, is that, you know, with a much wider investment pool, you can benefit from global disruption themes. And I think, you know, if we look at, say, the Kenyan market, we've got SAFCOM, or Safaricom, which is clearly one of the big disruptors there in the listed space. But in the global markets, you have a much broader pool of disruption to play for. So, for example, with the move to 5G on the mobile networks, you know, we're now able to cherry pick companies in that space and benefit from it. And then obviously the more sort of, or as important factors, you've got liquidity. Clearly the depth of global markets is significant. And I think, if you take the market cap of something like Apple, it's pretty much the same as Europe, and I think the DAX and the CAC markets combined. So there's plenty of liquidity out there in the global markets, which helps in times of crisis, because if you suddenly need to have access to your capital, you can put an order on, raise that capital, and you don't have the stress of not being able to get out of a position or having to write positions down. We then look at obviously the hard currency exposure, and clearly it's been very relevant for us down here in South Africa, where we've seen the rand depreciate by 20% or 25% since the start of the year. If you had your investments in the offshore, you're actually up, because obviously the markets have recovered, you've escaped the rand weakness, and you're sitting on a nice healthy return. And then lastly, risk diversification. So clearly, if any scheme has to warrant, particularly at times like this, the last thing you want to do is to have all your investment eggs in one basket. And by including an offshore allocation, you do sort of reduce that. You almost have it as an insurance policy for things that go wrong in your own domestic markets. And with that, I shall hand over to questions.
Thank you so much, Peter. That was quite insightful and very interesting. I see 2 hands raised. I'll allow Felista McKinney and Phoebe Kitili to talk. Please unmute your speakers and ask your questions.
Thank you very much. That was a very interesting presentation. My worry now is that, especially on the bad and the ugly, if already scheme is already in it, what would be your advice? Because now already the values have gone down, but already they are already in it. So now, how can we mitigate that?
Well, absolutely, and I think the 2 points there. I think obviously the companies that you would put in the bad sector, I would continue to hold those, because obviously the market has discounted the disruptions to the current operating environment. Clearly, there is some risk that they could fall further if things, if we do get a second wave of the virus, etc. But in all probability, they are strong companies, the likes of Starbucks, the likes of BMW, and once we see a normalization, or once we see one of the 3 sort of the cure or the vaccine, etc., come to the fore, we will see the market begin once again to value these companies as a going concern and pricing growth for future years. So that's the ugly. And it's very difficult to know when airlines are going to be able to operate in a normal environment and get their businesses operating as they were prior to the crisis. And the risk as an equity holder in an airline is that you are the first recourse of capital. So for the first guy that loses his money is the equity shareholder. And that's why we've seen such a dramatic fall in the share price. And my view is that the airlines, you potentially, certainly some of them will go under and you will lose your capital. And I think a very good example is yesterday here in South Africa, Comair filed for business protection. Now, that in itself doesn't necessarily mean it's going bankrupt, but the chances are you're not going to get much of your equity capital back. So I think to succinctly answer your question, stocks in the bad, I would continue to hold. Stocks in the ugly, I would cut and run. And I think there's a say in the equity space, your first cut is always the hardest cut. So hopefully that answers your question.
Thanks, Peter. Phoebe, if you may please unmute your speaker and ask your question. Phoebe Kitili. All right, as we wait for that, Peter, I have a question here from Simon Wanduga, who asks, is it fair to say that it is a bit late to buy gold now on the basis that price is high, and the only way it can go down is once we begin to recover? And then he also asks, is it fair to say that the low oil prices give airline companies a good recovery platform?
Fine. I think it is fair. I think the easy money has probably been made in the gold call. Absolutely. I think the reason why you would continue to hold a gold position is if you think there's going to be a second wave in this crisis. And I think the problem we have at the moment is the uncertainty, particularly of the US, because obviously we had Trump announce last night that he wants to normalize his economy, which one could argue is far too soon and could actually lead to a second wave. Now, if we do see that before the treatments that we discussed earlier in one of the slides arrive, then I think gold will have another rally up. But the problem is it's the easy money, as I said, has been made, but it's your view on gold now is whether you think the crisis from here is going to be or continue to be as devastating, or you're going to start to see some positive sentiment news. So I think my view would be to hold it, continue holding. Would I initiate a new position? No. As I said, it provides a part of the portfolio. So for example, in our global funds, we have about 5% of the portfolio in gold mining stocks. And the reason for that is just to act as a hedge against some of our other views not necessarily turning out correct. With respect to the question on the oil price, absolutely. If airlines were in a position to to be able to fund forward hedging on fuel, then I think yes, it would be great. But I think the problem or the difficulty we have is that when airlines start resuming flights, then the oil price is going to go up at the same time or start to trickle up. And it's whether the companies or the airline companies have the balance sheet which will enable them to hedge out oil in this point in time. Now, clearly, as I've said, a lot of these airlines are distressed. So I think my fear is that they're not going to be able to capitalize on this fall in the oil price. Those that are flying still, I mean, obviously in China, there's a few airlines that are flying still. They are definitely capitalizing on it. And as you quite rightly say, they should be generating much better earnings now than they were before the crisis, as if their costs are under control.
All right. Thank you, Pete.
So to answer your question, I think it's unlikely that they'll be able to capitalize too much.
Okay. I'll allow Gitau Masharia to speak. Gitau, if you may unmute your speaker. And Phoebe, if you're still there, please unmute your speaker and ask your question.
Can you hear me?
Yes, we can.
Yes.
Perfect. My name is Gitau Masharia. I'll take you back to a point you mentioned that a larger population, you've seen a trend in larger population investing or saving more. Do you have a focus on the mass market? And what would it be in terms of acquiring them? And how would they be able to get all this knowledge that you're mentioning as opposed to an institutional investor?
So the savings rate, which I mentioned, the increase in the savings rate, that's more of a reflection of the consumer not being able to spend his money elsewhere. Mm-hmm. So what you're seeing in the US is consumers that are still being paid on a monthly basis are saving that money, A, because they're not able to spend it, and B, I think because of they're being cautious on expenditure at this point in time. But where that's a positive is that it is sort of latent consumer demand. So as we move through, and if the lockdown or the removal of the lockdowns in the US are successful, and the economy begins to normalize in July, August time, then that money would then laterally be spent in the consumer discretionary sectors and should help the rebound in economic growth. So it's more, the observation is more that it's just what consumers are doing with their cash at the moment, as opposed to how they're actually facilitating that. But those numbers are based on the commercial bank's deposit rates.
Okay.
All right. Thanks, Peter. And then I'll ask the last question. So you say that the next few quarters are probably going to be worse. So what options are available for pension funds? And is it the right time for us to invest in the bad and the ugly?
Sure, absolutely. So I think just answering that, I think, the two things are, it's going to be worse for the corporates because obviously, the companies moved into QT with most of their operations shuttered, etc. But does that necessarily mean it's going to be worse for equity markets? That's the question. And as we've seen, in the height of the storm, equity markets staged a 25% recovery. And the reason for that is that equity markets are forward-looking. My personal view at the moment is that we've seen this bounce. I think there is always a risk that if we see some negative headlines about a second wave, that we retest those earlier lows. But I think our base case now is neutral until we've seen some some opening of the economy in the US and whether this sort of virus takes hold. So I think my view for pension schemes at the moment would be to keep a neutral allocation in equities in the global space. focus that towards the disruptive themes, you know, the tech names, etc., and shy away from the cyclical names where, you know, if things do prolong, then there is a huge risk of them falling into the ugly camp and you lose your capital.
Okay. Thanks a lot, Peter. I think it's been very interesting and very insightful. We wish we had more time, but because of time, I think we'll have to end it there. I'll invite my colleague Lydia to go ahead and just make a very brief presentation on N-Wealth, and then we'll wrap it up.
Good morning, everyone. I'll just go ahead and share my screen. Allow me a few minutes. Okay. So I'd like to say thank you to all our panelists, and thank you all our panelists, and also thank you to all our attendees. And just before we end it, I'd like to say something about our family and so we sing the song of with a retirement package, you can never really retire. With a retirement package, you can never really retire. And here we live for a promise of a better tomorrow. And so our vision is a dignified retirement life for all. Our mission is enriching lives through innovative social security financial services. And we achieve our vision and our mission through being innovative, through excellence, through enjoying our work, and through trust. And all of these values that we achieve our vision and our mission through are based on Christian faith. So we have 3 subsidiaries companies, and the first one is N-Wealth Insurance Brokerage Limited, and we also have N-Wealth Uganda and N-Wealth Mauritius, so we can serve you also from all those countries. Just to give you a glance of our statistics, we have been in operation for the past 10 years, and we have 40 technical staff. They have an array of professional. They have a wide range of professional specializations, and they can serve you well. Our assets are $620 million, not shillings, and that is what we have under administration. And just as I have mentioned, previously, that we are Uganda and we are also in Mauritius. So you can choose, and then we can also serve you from there. Our professional indemnity is $1 million, and we serve 50,000 members. So some of our products and our services, we have an array actually, and I'll just go through them. I'll just mention, and then I'll give us a contact at the end on which you can reach us, and we can explain. We can give further information on some of the services and some of the products that we offer. So we have fund administration services. That is why we exist. We also have retirement benefits consulting services. We have retirement benefits training services. We also have insurance and brokerage services. So we can also be your insurance solutions. You can reach out to us for that. And corporate trustee services, and then also on properties. Some of our products, I'll just go over them again. Lifestyle change management and financial literacy training. And then we have Anaya post-retirement healthcare. There you don't really have to worry about your medical funds when you get to retire, because this is a product that you can go right ahead and purchase. We have Keshohela Income Drawdown Fund, where you can invest a lump sum of money for exchange of benefits. And then we also have N-Wealth Personal Pension Scheme, and we have N-Wealth Diaspora and Expatriates Retirement Fund. So to understand all these products and what would be good for you, whether it's corporate or individual, you can reach us through the following contacts. You can email us on info@nwealth.co.ke, or you can also visit our website, www.nwealth.co.ke, and any of those contacts on your screen, you can reach us through that. We would advise you to not visit us in this time, but you can visit us after this situation that we are in. We are located along Gong Road on Morningside Office Park. Thank you so much for having us. We look forward to having more of you in the next webinars that we are going to host.
Right. Thank you, Lydia. And that brings us to the end of our webinar. And once again, want to thank Mr. Kenneth Kaniu and Peter Jarvis for your time, your expertise, and for the very engaging and enlightening sessions. We do hope that our participants have found value in it. If you have any questions or you require any more information from the two panelists, we will be sharing out the presentation and also contacts through which you can reach them.